Now, our main focus point today on InvestTalk is about shareholder yield. And most people don't focus on total shareholder yield. They just focus on the dividend yield. Now, you get shareholder yield when you add the dividend yield plus the buyback yield, the net buyback yield. So how many shares they're issuing versus how many shares they're buying back, divide that by the total value of the company in the market. That's where you get the net buyback yield. Then you add that to the dividend yield and you get the shareholder yield. And the reason why this is important to understand is that buybacks are more tax efficient. Dividends are doubly taxed at the corporate level as well as to you, the shareholder. Whereas buybacks, companies go buy back shares. Now there's a 1% tax on buybacks. It's pretty minimal. But ultimately, the real taxable event comes when you go and sell those shares. And so when companies buy back shares, that is a way to be strategic, buy shares when the stock is cheap. That also helps with lowering the share count, upping the growth of earnings per share that go net to you, the shareholder. And it's ultimately a much more effective and efficient use of net cash flow. So this is a trend you've seen as of late, which is companies that pay a small dividend, something that's very comfortable where the leaders don't have to worry about business going so bad they have to eliminate or cut the dividend. And then they're able to be more flexible with the buybacks and buy when times are good or the stock is cheap, and when maybe the stock's too expensive or the business environment is more murky and uncertain, maybe they can pull back on those buybacks. So shareholder yield is a much better measure of stability of the business and shareholder friendliness of capital allocation than simply dividend yield.